Yes, so the control account's main purpose is to give us the total amounts, all right? For example, your receivables control account is going to give you the total amount your debtors are owing you. Your debtors or your receivables are owing you, all right? The payables control account will give you the total amount you are owing your payables, all right? Because remember, as a business, you're not only going to have one receivable and one payable, you're going to have a lot of them, all right? And you find there are tier accounts in for the for the receivables. You find it in the receivables ledger or the sales ledger, and this is where you find all the tier accounts for everybody who's owing you, all right? And then in your payables ledger, where you find the tier accounts of every supplier you are owing so that you know each individual person, you know how much they are owing. All right. Then the control account just tabulates, puts all of them together. Right. If you see on your trial balance or in the balance sheet, you see an account called trade receivables or trade payables. That's representing their control accounts because you can't put everybody, every receivable and every payable in the trial balance, all right, or in your balance sheet to make your balance sheet too big, all right. So these control accounts, these are the ones which we find on our balance sheets, all right. Receivables is found under the current assets, right? The payables is found under the current liabilities. So now the journal entries you must be familiar with. All right, let's refer to this document here. I've sent this document to you. So journal entries you must be familiar with. All right, credit sales. All right, credit sales. Because whenever you sell on credit, you always form a receivable, and remember, a receivable is an asset. All right. So credit sales is one general entry we'll be focusing a lot on. All right. Credit purchases, two. Also credit purchases. All right. When we buy things on credit, that's how we form a payable. All right. Because if you buy it with cash, you're not going to have a payable. If someone buys a good with cash, you won't have a receivable. All right. Then also sales returns. All right. When a receivable brings back goods to you, right? You're going to you have to debit return inwards. This is a contra revenue account, and you have to credit receivable because this is like a decrease in the receivable, all right? And also, which are the entry purchase returns? If you return goods to people who you are owing, all right, you have to be familiar with these journal entries. Even discount allowed, right? Remember, this is whenever you want people to pay you fast, all right? You obviously offer them a discount because if you have a lot of people owing you money, you obviously want them to pay you fast. So one way to make them pay faster is you give them a discount. All right. So if you give your customers a discount, all right, discount allowed is like an expense to you because you are losing money. All right. So that loss of money, which is the discount, is debited to your account. All right. And also the cash will be debited to your account. Your receivable is obviously once they hear that discount, they're going to pay, and that's a reduction in the receivable. All right. And then the other journal entry also, discount received, right? If you are owing a supplier and the supplier wants you to pay them first, they're going to offer you a discount. All right. So that discount on your side, that's like a gain or sort of a form of income. That's why it's credited. All right. And since you're paying your supplier, so that will be a reduction in your payable. All right. So those are the journal entries we have to familiarize ourselves with as we are dealing with control accounts. So I'm going to illustrate how the control accounts work. Right? I'm going to illustrate everything on how these control accounts work. We'll start with the receivables ledger, the receivables control account. Right. So let's say we're a business, right? Let's take note of the credit sales we've had for the month, right? Let's say Mr. Banda bought goods on credit. Mr. Banda on credit 1,000. More goods on credit one. So let's say you're a small business, right? These are your credit sales for the month. All right. Remember the where we record our credit sales is in our sales day book. All right. Sales day book. Okay, that's where we record all our credit sales. Right. All credit sales. Right. So whenever someone buys on credit in our sales day book, we record, right? We record each entry and we open a T account for each person, right? So on our sales day book, you put Mr. Banda, Mubanga, Mike, Mike, and Jack. You record all the credit sales 1,200. So this is just a fast illustration of the what happens in the sales day book 800, 1,500. All right. You record all of them. All right. You even total them up. Right. 4,500. Right. Now, what's going to happen is we're going to open the T accounts of each of these people. All right. All of them has to have their T account. All right. So you open for Mr. Banda, Mr. Muvanga, Mike, and Jack. All right. So let's just open their T accounts. All right. So whenever we make a credit sale, all right, the journal entry is you're going to debit the receivables, debit the receivable, and you credit sales. All right, debit the receivable and you credit sales. All right. So for these, each of these individual journal entries, all right, you are going to debit the receivable and you credit sales. All right. So in this illustration, the sales account is not important. All right. We're focusing on the receivables accounts. All right. Found in the ledger. This is our ledger. Yeah. We'll have each of the receivables who are owing us money. Right. So each of these receivables, we're going to debit them. All right. And you're going to debit him 1,200, right? Because when you make a credit sale, that's an increase in sales. Sales is a revenue account, all right? Let's go to the double entry rules, right? Sales, where is sales here? Revenue, okay? Revenue increases with credit. So sales is a revenue account, so it will increase with credit. All right. Receivables are an asset, so they increase with debit. Okay. So each of these you debit 1,200. Right, Mr. Mubanga. Also him here, Mr. Mubanga. 1,200. 1,000. Right. Mike, also you debit him 1,000. 800. Right. And Jack, you debit him also 1,500. Okay, you debit him 1,500. All right. So instead of making four different journal entries, all right, for Banda, Mubanga, Mike, and Jack, you just tabulate the total of how much everybody's owing you, all right, which is 4,500. All right. When you get the total in these tier accounts, it all totals up to 4,500, right? So your general entry will just be debit 4,500, the receivable, and this is going to the control account, okay? Because remember, the total from this ledger must be equal to the total on the control account, right? The total from the receivables ledger, where we have all these tier accounts here, when we add 1 to 1,801.5, we get 4,500. This is the total that must also be on the control account. All right. So once we've totaled them up, you open the control account, the receivables control account. All right. The receivables control account. And you put here 4,500. All right. That's the whole key here. Total from the receivables ledger must equal to the total on the control account. All right. Okay. Any questions before we now add um, return inwards? All right. We add return inwards to these transactions, then also add payments and also add some discounts so that we see everything that's happening in this account. Any questions? All right. And this is the what's going to go on your balance sheet. All right. Let's say the month ends. All right. This is what's going to go on your balance sheet under current assets. All right. All right. Let's now add in some sales return inwards or some sales returns. All right. Right. The sales returns are recorded in the sales returns day book. All right. In the sales returns day book, that's where we record the sales returns. So let's say, for example, Mr. Banda brought back goods worth 175. Right. Mubanga brought back goods worth 200. Right. Then let's say also Mike brought back goods worth 100. Right. And Jack brought back goods worth 300. Right. So in your sales returns day book, all right, you have the same people. You'll be writing them down. All right. So you say here 175, 200, 100, and 300. All right. Oh, wait. This is 3,300. All right. 775. All right. So, all right, we do our double entries. All right. Because remember, for return inwards, the journal entry is, all right, return inwards or sales returns. This is a contra revenue account. Right. Return inwards. All right. You're going to debit return inwards. Why? This is a contra revenue account. If we go back to our double entry rules, right? Revenue accounts increase with credit. So a contra revenue increases with debit. All right. A contra revenue will increase with debit. Now, since your receivable is bringing back goods, that's like a decrease in our receivable. A decrease in the receivable is credited. So you're going to credit the receivable. All right. So, Mr. Banda, we're going to credit him 175. All right. The return inwards T account is not of importance here. All right. The return inwards T account is also going to have all of this. All right. But here we're just focusing on what's happening to our receivables. So ignore the return inwards T account. All right. So Mr. Banda, 175. At Mr. Muvanga, 200. All right. Mr. Mike, 100. All right. Remember, our receivables are reducing. That's why we're crediting. All right. And Jack, 300, right? Back 300. So let's tabulate what they're owing us after they've brought back these goods. All right, so 1,200 minus 175, 1,025, 1,000 minus 200, 1,000 minus 200, we get 800 here. Right, 800 minus 100, 700, and 1,500 minus 300, 1,200. All right, 1,200. Okay, so on our receivables control account, all right, we're going to have to now total up our sales returns. All right, we have to total up our sales returns. All right, so this 775, all right, this 775 will come in our receivables control account here. 775, the total sales returns. All right, sales returns. We tabulate how much in total everyone is owing us. 45 minus 775, 3,725. So this must agree from the total in our ledger, in our this receivables ledger. So we're going to add, we'll say new total in ledger. This was the old total, 45. Now the new total. New total, you're going to say 1,025. Right, Banda is now owing us 1,025 because he returned goods worth 175. Plus, Mr. Mubanga is now owing us 800 because he returned goods worth 200. Plus, Mike is owing us 700 because he returned goods worth 100. All right. Plus, Doug is owing us now 1,200 because he returned goods worth 300. All right. So the total in our receivables ledger, 3,725 is similar to the total on our control account. Here's the journal entry for the return in ones. 775. And here we have
Excuse me, sir.
yes.
Why have you put the answer?
Yes, yes.
I'd like to ask, why have you put the sales return on the receivable control account? Why have you put it on the credit side? Is it not supposed to be on the debit side? I don't know, the return ones.
Return inwards, you are bringing back goods, right? you are bringing back goods. So what you are owing to the person is going to reduce, right? So that reduct. So you as a receivable, you are reducing. Okay. So a receivable is an asset, and a reduction in an asset is credited. All right.
Say that again.
I say that too. Whenever you are returning goods, all right, as a receivable, when you return goods, meaning the amount you'll be owing that person will lower, right? When you return those goods, the amount that you're owing is going to drop down. So since you are a receivable, so that's like a reduction. You are reducing the amount, so that's a reduction in you as a receivable. And a reduction in a receivable is like a reduction in an asset. And a reduction in an asset is credited. All right. Reduction in an asset is credited. All right. That's how we're crediting the receivables. Then return inwards, it's a contra revenue account. All right. Meaning it acts opposite from a revenue accounts. Here's the rule for revenue accounts. All right. They increase with credit and decrease with debit. That's a revenue account. But a contra revenue is the opposite. It increases with debit and decreases with credit. So that's why we have debited the returning ones and we've credited the control account. Are we okay, Mr. Charles? Just remember these are asset accounts. All of these are asset accounts here. All right. All of these are asset accounts. So the double entry rules that apply to assets apply to these accounts here. All right. So these accounts increase with debit and they decrease with credit. Okay, let's now deal with some payments. All right, let's deal with some payments where our receivables are paying us. All right, so let's say cash payments. These are recorded in our cash book. Okay, they're recorded in the cash book. All right, so let's say Mr. Banda. So Mr. Banda pays 500. Right. Mr. Banda pays 500. Mr. Mbwanga pays. Mr. Mbwanga pays, let's say, how much is he owing? Don't overcharge him. Let's say he pays 800. All right. He pays the whole 800. Pays. And then let's say Mike pays 300. Right. So here our receivables are paying us. All right. They are paying us. So when they are paying, it's also like they are reducing. All right. Once a receivable pays you, it's like that's a reduction in an asset. All right. And remember, a reduction in an asset is credited. And when a receivable pays you, you receive money, all right, cash. So, and cash is an asset, and an increase in an asset is debited, all right. So here, this guy pays 500, this other one pays 800, some pays 300, right? You total up, all right. So yeah, up 1,600, right? General entry will be cash, right? This is just the for the whole at the end of the month, right? The general entry will be cash 1,600, right? Because cash is an asset. Then our receivables we credit 1,600. So now we're going to the T account so that the ledger should agree with the control account, right? The ledger should agree with the control account, all right? So we are going to go to our individual receivables, all right? So Mr. Banda pays a 500, all right? So we go to Mr. Banda's T account. He's paid a 500, all right? This was a return invoice. Pays a 500, all right? Pays a 500. So now let's find out how much he's owing in total, all right? Because he's now paid a 500. Let's find out how much he's owing in total, all right? So you say 1,200 here. You see which one is higher between debit or credit. Debit side, all right? Balance carried down. Let's total up here. 175 plus 500, 675. So we're going to say 1,200 minus 675. All right. So Banda is now owing 525. All right. Is now owing 525 kwacha. Okay. He's now owing 525 kwacha. All right. He returned goods. Is now paid. Okay. He's now paid the 500. So he's now owing 525. All right. Mr. Mubanga. Okay. Mr. Mubanga also him. He paid how much? He pays 800. Right. He pays 800. Right. Find how much is owing. He's not owing any amount. Mr. Mubanga is closed. All right. He's not owing any amount because 800 plus 200, that's 1,000. 1,000 minus 1,000 is 0. Right. So Mr. Mubanga has been cleared. All right. Him is owing 0. All right. Mike pays 300. Where's Mike's account? Mike pays 300. Right. So here, RI, return inwards. This is cash payment. 300. Right. Let's find out how much Mike is now owing. 800. Here we have 800. Right. 300 plus 100, that is 400. So 800 minus 400. Right, so Mike is now owing 400. All right, Mike is now owing 400. All right. Then Jack, how much is Jack paid? Did Jack pay? Oh, it's only these two. All right, only these three. So how much? We find out how much everyone is owing us in total. All right, here's now the other new total, right, of how much everyone is owing us. So that's 525 plus 400, 925, right? On our control account here, all right, the total cash payments is 1,600, all right? So cash payments, 1,600, right? So find out our new total, right? So I have to erase this 3725, right? So you put 45 here, 5 here, all right? So we total up here is 1,600 plus 775. It is 2,375, right? So we get our carried down 45 minus 2,375, 2,125. Interesting. Interesting on that one. Cash payments total 162. Let me review first. Let's see. Cash payments 16. Oh, did I add Jack? I never added Jack also. Jack's total here. Yeah, Jack, it's still 1,200. All right. Forgot to add Jack's total. Right. Jack never paid us anything, so he's still owing us 1,200. So actually, it's supposed to be 925 plus 1,200, 2,125. Yes. So they are equal. All right. They are equal. Why did I do that? They are equal. Yes. Any questions? So here to be that 2,125 comes here. 2,125. All right. So they have to be the total in your ledger, which is 2,125, has to be the total in your receivables control account. All right. These totals have to equate to each other. All right. Any questions?